Hi, I'm Charlene Laney, co-founder of Newmaker Financial and certified financial planner professional. Today, what we'll be talking about is one of the 5 key investing strategies that we advocate for here at Newmaker Financial. And it's going to be item number 1. Very, very important. Do not try to time the market. Maybe a little bit harder than it sounds, right? I feel that even the most savvy of investors are tempted to try this. But just know that you are never going to sell exactly at the top. And on the flip side, when the market's going down, you're never going to be able to catch a falling knife. And the difficulty here, of course, comes in the fact that when you try to time the market, you have to be right twice. You have to know exactly when to get out. You have to know exactly when to get back in, or vice versa. So what we like to say instead is rather than trying to time the market, focus on your time in the market. As an example, if we look at the S&P 500 from the years of 1995 to 2015, a full 20-year period, and mind you, 2 recessions occurred during this time frame, 2 bear markets, that of the dot-com era, 1999-2000, as well as the Great Recession in 2008, and recovery through 2009 and beyond. Knowing that occurred over this time frame, had you stayed invested in the S&P 500 for that full 20 years, your average rate of return, meaning on average every single year, your annualized return, was approximately 7.68. Now, for that same time frame, had you missed even the 5 top days of market trading, your return would suddenly be ratcheted down on average to 5.5%. Had you missed the top 10 days, then all of a sudden your returns are nearly cut in half, where you're only averaging about 4% every year. And then, of course, even worse if you miss the top 20 days of 1.57%. Now, I don't know about you all, but if I think about just the last 10 days, for example, and how quickly that time frame has gone, it's very, very easy to miss the top market days in trading. Now, they may not even be consecutive, but nonetheless, recognize that day to day, to be paying attention to this sort of thing and to try to catch when the market is going to be doing a stellar job and when it's not is very, very difficult. Even as a full-time job, it's hardly achieved with accuracy, precision, and consistency. So again, focus on time in the market, not timing the market. And I recognize too that as humans, it is difficult for us to do this because our emotions get in the way. And not to say that your emotions are bad or should be ignored, but when it comes to your money, we want to take a very objective and data-driven view. What tends to happen when we're thinking about buying low and selling high, which again, easier said than done, is that when the market is low, we know that it's time to buy. Logically, we know, but we tend to feel that the market is low, it's going to keep going lower. Why would I get in now and then suddenly lose money? We become more fearful of investing. And then on the flip side, when the market is high, we get very greedy. We see that the market has been going up and up and up, and we think that that trend will continue on into perpetuity, and that's actually the time that we should be selling. So, all this is to say that we don't want you to time the market. Really, what you should be doing is focusing on having as much time in the market as possible. And when I say the market, I am talking in broad terms, of course. There is a stock market, there is the bond market, there are alternative markets, but the appropriate mix of those asset classes should be determined by a financial plan that you've put together with your financial planner, with an investment fiduciary who is looking out for you. Because we want to set up a portfolio that's essentially like all season tires for you to weather the ups and downs of the market. And so all that is to say, have a plan, don't time the market. And we'll be back here soon with more key investing strategies for you. I hope this was helpful, and let's talk soon.